Well, good morning and welcome to a fresh edition of IPO Watch right here on Money Control. I am Nandita Khemka, and today, of course, we are putting the spotlight on a company that we're no stranger to. Really, every now and then, we end up using the services. Urban Company, that 1900 crore rupee IPO has hit the street today. It has opened up for subscription. The company has already, raised somewhere around 854 crore rupees from the anchor book. To talk about the future roadmap and post-listing growth strategy. We are joined by by Abhiraj Singh Bhal, who's the chairman, managing director, and CEO of the company. Abhiraj, welcome to the show. As I was mentioning, all of us have at some point or the other used services from Urban Company rather. Earlier it was Urban Clap. So be it household, be it beauty and wellness, etc. And of course, you guys have, of course, now are making your debut on the Lal Street. You guys have already turned a unicorn in the past. Some marquee names that I was going through via the anchor book, names like Goldman Sachs, Government of Singapore, SBI Mutual Fund, ICICI Prudential MF, HDFC Mutual Fund, AMC, etc. No, a lot of marquee names have participated. So you've started off with a good response to your IPO. But tell us, from turning into a unicorn to your the Lal Street debut, tell us how has the journey really shaped up for you guys?
Nandita, firstly, thank you very much for having me. It's an absolute pleasure. Um, Nandita, we started this company from my living room in November 2014 with the vision to organize the world of home services, bring in standards, quality control, and reliability for end consumers, and also empower service professionals to lead dignified, respectful middle class lives, upskill themselves, and move up in their career trajectory. We've been on that mission for the last 10 years, but we still believe that we are a small company in the scheme of things. We are in a very large market. The total addressable market for home services in India is more than 5 lakh crores. And a very small percentage of that market today, less than 1%, is organized and online. So, if you ask us, we think it's day one. We think we're only getting started. We think the job ahead of us is to work hard, organize this market, and delight consumers and service professionals alike.
Sure. Of course, organized is very, very less proportion, right? And you guys are taking on the unorganized sector, so to say. So in terms of that, and before we delve into financials, we'd like to know about your pricing strategy. Would it be similar going forward as well?
I think our business model, Nandita, relies on densification of the micro markets in the network that we have created. As we densify our micro markets, our service professional utilization improves. Their earnings improve, which we have been transparently publishing for the last few years. Every year, their earnings have been going up. And consequently, the overall systemic costs to serve the customer come down, which also translate into better pricing for consumers. So that will be our endeavor, which is to continue to scale, continue to densify the network, and continue to offer higher earnings to service professionals and better pricing to end consumers.
Mhm. Fair point. Now let's talk about your top line growth, revenue from operations. They've been growing quite steadily. If you look at FY25, it was at a compounded annual growth rate of 34-35% odd. And over the last couple of years, you have been growing steadily in that range. Is this run rate sustainable, over the medium term, or do you expect some moderation given the fact that you have diverse revenue streams and not all of them have really fired up yet because they are a little more new? They are new in nature. So, do you expect to continue this run rate going forward as well?
That's a great question. And if I was to talk about the last 3 financial years, we have grown revenue from operations from about 437.6 crores in FY22 to roughly 1144.5 crores in FY25 on a base of a net transaction value of about 3,271 crores. So the company has grown well in the last few years. It's tough to say how much faster it can grow in the future. I will avoid giving any guidance here. But what I will say is that the opportunity is large and we are a committed team. We will work hard and we are ambitious to continue to grow at
Hmm.
a healthy pace, while, of course, keeping one eye on profitability as well.
Sure. Profitability, since you mentioned that, let's talk about that in details then. For most of the platform companies, profitability was an area of concern. Of course, the platform companies promise long-term growth, but in the near term, there's a lot of cash burn, and investors are worried about the path to profitability and how soon the company will really turn profitable. But for you, that has not really been a problem. Because FY25 marked the first year of profitability. PAT was somewhere around 240 crore rupees. But of course, there was a deferred tax credit as well to the tune of 211 crores. But still, you guys had a profit of 28 crore rupees or thereabouts. So, how should investors look at this adjusted profitability number? And how do you plan to strengthen this trajectory going forward?
So again, if I talk about that 3-year period that has gone from FY22 to FY25, in FY22, our EBITDA was negative 373 crores, and in
Hmm.
FY25 it was positive 12. So of the 707 crores of incremental revenue that we added to the top line in that period, 385 crores moved to the EBITDA, and more than 500 crores moved to the PBT. PBT in FY22 was minus 514 crores, and it became positive 28.6 crores. So more or less, I would say that the company is, you can think of it as a sort of break-even kind of stage right now. These are all very
Hmm.
small projects. The deferred tax asset, of course, is just an accounting treatment in lieu of future profitability. I think our goal will continue to be to grow at a healthy clip, continue to improve margins, particularly for our India consumer services business, which is already profitable. EBITDA margins were about 10% in last year. And that's our mainstay business, and we would want to continue to grow it
Hmm.
with improving. Our newer business segments,
Sure.
whether it's native, will
Go
require
on, go
more
on.
investment.
Okay, it will require more investments, as you said. But you have newer streams as well, right? Native being one, water purifiers and electronic locking systems, etc. They haven't fired up yet. Any long-term vision with respect to these newer verticals or new products?
Yes. So, as I mentioned, I think the two new segments, Native and InstaHelp, are still very nascent. They will require more investments. They're growing very fast. In Native, we have two products, the water purifiers and the smart electronic door locks. They've gotten off to a great start. They're growing rapidly. Margins are improving. And we are confident that in the coming years, that this will be an important business segment for our company. And eventually, with improving top line and operating leverage playing out, it will turn profitable and over time be a profitable segment as well.
Got your point, but you said that these newer streams would require some investments. Would that be margin dilutive in the near term for the overall business?
Most likely, yes. And what we are
Hmm.
committed to doing is very, very transparently disclosing right from the first earnings call itself, the different business segments, how they are growing, what is their contribution margin and EBITDA margin looking like, and what will be the runway of investment before we can uh, turn a corner as far as profitability is concerned in these newer business segments. We want to continue to invest in growth, and we want to continue to disclose transparently to our shareholders the economics of every business segment so that they can make judicious decisions around the company.
Hmm. So, any other key levers that you're working on to structurally improve margins? Because I think currently EBITDA margins are somewhere around 1%. Do you aspire to reach the 3 to 4% anytime soon? Do you have any timeline in mind for that?
Yes. So if I talk about our core India consumer services business, it was already at a 3% adjusted EBITDA margin last year as a percentage of net transaction value and 10% as a percentage of net revenue. And in the first quarter of this financial year, the India consumer services business was at a 4% margin as a percentage of net transaction value. So it is seeing improvement. We will continue to see improvement in other areas as well, whether it's international or native. InstaHelp is very new. It's only 6 months old. So it'll actually see a phase of investing for us. before it breaks even. And as I mentioned in the first earnings call itself, we are committed to coming out with clear guidance on InstaHealth. What is the runway it will require before it turns profitable, and what kind of investments will it take?
Hmm. Again, I'm asking you a question in terms of your valuations. I know it's sometimes sure the shareholders would like to know that, which is why I'm asking you again at the upper price band of 103 or thereabouts. Urban companies seeking a valuation of somewhere around 15,000 crore rupees or so, and experts believe that it could be a tad bit rich. Given the fact that operating margins are still slim, and you guys, of course, diversifying into newer streams, and that will, of course, require more capital. Of course, you have losses in new verticals which are being cushioned by the India services business, as you have already mentioned that. How do you justify the valuation premium?
So, Nandita, how this exercise happened was that we had a large pre-IPO round, which was led by some marquee investors like SBI Mutual Fund, Birla, Process, and Elevation Holdings. They purchased approximately 500 crores worth of shares in the pre-IPO at a price of 103 rupees per share. And that set the upper end of the price band. And then, of course, the investment bankers also uh, built the anchor book and took guidance from the anchor book on what is the right valuation. You would have seen in the anchor book not just a lot of new investors participating, but plenty of existing investors of Urban Company also participating. Steadview Capital, which has been an investor on our cap table for the last 7 years, has participated in the anchor book. So has Think Investments, so has Arohi, so has Dragoneer. And both Elevation and Process participated in the pre-IPO. Elevation was our first institutional investor. It's been with us for 10 years. So it's not just new investors, it's also existing investors who are already shareholders who are showing faith in the IPO. Eventually, of course, we will have to work hard. We will have to grow the company. We will have to generate profits. And when I say profits, I'm very clear that it's PAT and it's cash flows. Those are the final metrics, adjusted EBITDA. These are interim metrics to guide investors towards what eventual profitability will look like, which is PAT and cash flows. And those are the metrics that will eventually define how the company will be valued. And as builders and operators, we have to focus on value creation. We have to focus on creating a company that is highly valuable for civil society at large, and believe that valuation will be an outcome of that exercise.
Hmm. Fair point, Abhiraj. Okay, let's talk about expansion as well. Uh, in terms of international presence, you are present across, I think, three other nations, in the UAE, Singapore, and Saudi Arabia. Do you plan to deepen your presence? And at present, I think you're present in 51 cities. Any targets in terms of scaling up? How many cities you would be targeting and by when?
Nanda, you're right. We are present in three markets, in UAE and Singapore through wholly owned subsidiaries, and the Kingdom of Saudi Arabia through a joint venture. And in India, we are present in about 47 cities out of the total 51 cities which are our footprint. We really see the opportunity in India to be quite tremendous. Even in these 47 cities, we would not be present in all micro markets or all service categories that we offer in some of the larger cities. So within these 47 itself, there is plenty of headroom for further penetration. We will, of course, in a calibrated fashion, continue to add cities in India. We don't expect to enter any newer international markets. I think we have our hands full with the opportunity in India and the opportunity in these three markets. And so for the foreseeable future, that will be our focus area.
Hmm. Got your point. In terms of some risks to business, especially internationally, where house help is expensive and often regulated, your subscription-based cleaning services make sense. But do you foresee any regulatory, or operational or even currency-related risks as you expand abroad? How you plan to mitigate them?
I think, Nandita, every business has risks. And as management, it is our job to fully understand those risks and ensure that we put in place systems and processes to mitigate those risks. And if well mitigated, often risks can also become a competitive advantage for the company. As an example, we operate in the home services segment. A big risk for both consumers and service professionals alike is the risk of safety and trust. You're welcoming a stranger to your home. We have institutionalized several trust and safety processes, from background checks to SOS helplines, quick response teams, an internal trust and safety desk. And over time, customers and service professionals have realized that going through the platform is safer than offline, and it has become a growth driver for us. So any risk, whether it's regulatory in nature, whether it's currency related, whether it's core operational risks, which are the real long-term risks in any business, have to be looked at from the lens of mitigation and have to be looked at from the lens of defining systems and processes which can work as an advantage for the company in the long run.
Hmm. Sure, one of the other risks that just came to my mind is that of customers and professionals bypassing the platform. There have been, I'm sure that you must have experienced or seen that the instances of that happening as well. How do you keep track of this leakage? And could this also be a big risk going forward? How are you looking at this end of the spectrum that happens?
Again, with the same approach, the approach of adding value to both sides. Over time, what we've realized is that if we continue to utilize our service professionals better, and if the earnings that they get through the platform as a combination of our pricing power, utilization, and career trajectory we offer them is superior to going on their own, they choose to go through the platform. And we've seen this in terms of more and more time commitment and more earnings that professionals make through the platform. And similarly for consumers, if consumers are convinced that going through the platform helps them get services quickly on demand, highest quality of services delivered because the professional is working hard for that five-star rating, is following all the quality SOPs and compliances, and there is grievance redressal, customers also prefer to go through the platform. So it's really about value addition. You can't prevent anybody
Hmm.
from leaking off the platform. If that's happening, then the value add of the company is limited, and the company has to continue to work hard to define those systems and processes and add that value. So again, going back to any risk, it's all about looking at it from a first principles perspective, defining those systems, processes, value additive levers to sustainably mitigate that risk in the long term.
Hmm. Okay, give us a sense on, what are your other diversification plans? Because you've diversified into a lot of segments. You also have diversified into products, so to say. But what are the other segments that you would be looking to tap into going forward?
I think we have our hands full. As you rightly say, we've diversified a bit. So we have our hands full with whatever we are doing right now, whether it's native, InstaHelp, our core services business in India, or the three international markets. It's a lot already. And I am mindful of the fact that it's important for companies to continue to focus. That's not lost on me at all. So I think for a while, we will continue to just stay put in where we are and focus on these areas.
Sure. Of course, any message to your prospective shareholders? I mean, of course, you've all used your services and good to see you in the listed universe as well. So any particular message that you would like to give your prospective shareholders using our platform?
I think I'd like to say that it's the start of a new journey for us. We believe we are just getting started as a company. We will be committed to transparent and honest disclosures. We will tell you the picture as we see it. Bad news will always come to you first. Good news can wait, but bad news will not wait. And we will work hard, very hard, to deliver shareholder value.
All right. Focus on the good and, of course, working hard to deliver shareholder value as well. With that, Abhiraj, would like to thank you for taking out time and joining in. All the best for your IPO. And I hope to interact more often now that you are in the listed universe as well. So all the best for your listing as well. Lovely chatting with you this morning.
Thank you, Lisa. Thank you so much. Pleasure talking to you.
Thanks a lot. Thank you. Well, that was the management of Urban Company. We've all used the services. Now, of course, the company is making its debut on the last week as well. The IPO has opened up for subscription. So yes, that's a 1900 crore rupee IPO. But with that, we're completely timed out on IPO Watch. Stay tuned to Money Control for all your other news and updates. And of course, we'll see you soon. Thank you.